Hi, Ron here. This video is going to show you techniques for combining Andrews and Gann. I have to assume that some of the people that are going to see this video have no experience with Andrews and have no experience with Gann. So I'm going to make this some interesting. That's something for everyone. Now, one of the things that we know that Gann liked to talk about was something called the head and shoulders and inverse head and shoulders. Very simple. That sometimes it'll look like there's a head and a shoulder, and this is the inverse one, and then this thing here is called the neckline. See, so here you have the head, here's a shoulder, here's another shoulder, here's a neckline, and usually these things aren't upside down, also known as inverse. Usually sometimes they're right side up. Here's a shoulder, here's a shoulder, here's a neckline. Okay, so what we're going to look for is Gann's head and shoulders pattern. Simply look at charts and find his head and shoulders pattern. That is step one. Not real difficult. But why are we doing that? Well, because you see, with Gann, the theory is that after prices pass through the neckline, which is over here, for example, or over here, for example, that they'll then go up to the target. And I'll show you how you get the target in a minute. With Andrews, the importance is good probability trades and a very good risk-reward ratio. So with this particular technique, you take the tip of the head and you take the neckline, and the target is this line up here, which is a move that is equidistant from the head to the neckline as the neckline to a future value that's further. Now here's the cool thing about Andrews is with Gann you have a static target and you have this static entry of past the neckline. With Andrews you can typically get in closer to the shoulder, and in some cases you don't have a signal with Andrews after it goes, and you notice that after prices have already gone through the neckline. But in this case here you had one, here you had one, here you had one. And so what happens is that you would normally, using Gann, draw this here and say, okay, over here is your target in terms of your exit area. But with Andrews, you can also use a more dynamic determinant in order to see what's going on. You see, one of the things that we know with Andrews is that if prices go up and make the median line and hang out above it, and then go down and break that lower parallel, the next time up, well, watch out, because then there's going to be a good down move. See here? Now sometimes when they go up to the lower parallel, or they go up to the median line and turn. Either way, same thing. Let's see another example of this. As you can see here, prices went up past the median line, real nice, came down below it, went up to that lower parallel again here, and boom. Okay, this gives you a static exit and a dynamic exit. Now if you look here, using the standard technique, well, you might have use this point here as an exit. That's fine. You can use this here in order to get your risk-reward ratio. So when you get your Andrews entry, which is down here rather than your standard Gann entry, which is up there, you can see that the risk-reward ratio is much better. And with Andrews, when you see that prices, yes, they've reached this target, but probability is that it's just going to keep on going until, as you see here, prices broke the lower parallel, came back up to it, and then that was probably a good place to get out, even though it went a little higher on two brief occasions. See, so once again, this was your neckline on a regular one. When prices came down, Andrews people would not have been short here because there's no standard signal here that we use for this kind of pattern. So those of you that are Andrews students, one of the first things that you want to look at for an entry is something called the golden pivot rule. Let's see this again. See, prices are going up here. They come down, boom. Not a bad place to get out. Let's see where the static target would have taken you. Static target would have is waiting for prices to come way up to here, which is not a problem, because if somebody gets out here and then later on gets in here and takes the ride up, they wind up missing out on all this gut churning up and down. One of the things that's important is being able to use this in ETFs where foreign currency is in play. And the reason is because in this particular ETF, which is a Thai fund, you have two important factors. You have the value of the underlying stocks in Thailand, and then you also have the currency factor that's thrown in that makes up these prices. And so here's an example of here. Here you have your shoulder. Here you have your shoulder. Here's your head. Okay. And you can see with the dynamic Andrews techniques, stayed in longer. Now with Gann, if you were to go long here, you might go long after prices break through this line, which would give you the risk all the way down to here, which is substantial, and substantially more than the Andrews entry, which would have been down here somewhere. So what I encourage you to do is go to www.andrewscourse.com and click on the products page and then click on Buy Now. In the manual you'll find the golden pivot rule, and you'll find other important concepts that'll help support you as a trader. Thank you for your time.